welcome on board Dipan Mehta as well and find out what he's making of the market so far and what it's likely to do. Dipan, hi, morning. Good to have you on the show as always. Dipan, the talk this morning, of course, is HDFC Bank. Couple of brokerages have actually, decreased their weightage on HDFC Bank in their core portfolio schemes. You think the concern is not just the run-up which has already happened in the stock, but also the quarterly updates, which were a little bit of an eye-opener, wherein the CASA deposits have declined and advances also showed just about a modest growth?
Yeah, good morning and thank you for having me on your show. I think the disappointment with HDFC Bank continues. And now there is so much of choice in terms of banks, and so many banks and NBFCs are growing much faster than HDFC Bank as well. And perhaps the only reason to own HDFC Bank at this point is because of its very high weightage in the Sensex and Nifty. And if you're benchmarking against them, then you have to invest in HDFC Bank. But by and large, I think from an individual investor's perspective, it is best to avoid HDFC Bank. And if you're already owning shares as we do, then we should be looking at exit opportunities. Overall, in the banking sector, there could be a trading play as liquidity may improve post RBI policies in 2025, maybe interest rate cut. So these are triggers for the banking sector, the BankX to do well, maybe in 2025. But when you look beyond on a medium to long term basis, I think that banks per se may not deliver the superior returns they have done in the last decade or so. So investors must think in terms of being underweight the banking sector in the medium to long term.
All right. Hi, Dipan. This is Shrishti also joining in. Help us with your take on Reliance as well, because just today we have two of our brokerage notes coming in wherein Jeffrey believes that the valuations are quite reasonable. The stock is trading at the cheapest valuation since the COVID shock. And even Bernstein says that they believe that 2025 will see a recovery cycle. In 2024, Reliance has done actually nothing. But for 2025, what is your outlook?
See, I think that there are no really triggers to buy into Reliance Industries. And now I think the news is coming that for Jio, they may do an IPO and not a split of the company, which means that more and more holding company discount will come into Reliance Industries. And that's not good for minority shareholders. And apart from that, I think, the O2C business remains highly cyclical. And with the way we are seeing disruption taking place in the auto industry and the spread of EVs, that's certainly going to impact longer term impact on fuels and crude oil as well. So I'm not that positive on Reliance Industries. Again, same thing at the HDFC Bank, because there is such a large weightage in the Sensex Nifty. It has to be a must-own stock if you are tracking these indices or benchmarking against that. But as such, there is no real trigger to buy into Reliance Industries. In fact, if they go for IPOs for Reliance Retail and for Jio, then certainly the stock price can correct even more as more and more holding company discount will come into play.
So where is it, Dipan, that you think that growth fillip is going to come in and we're going to see a slice of that this earnings season as well, and where you have some amount of valuation comfort at least?
I'm sorry, I didn't get your question.
No, I'm just wondering, where is it that you see growth then? If not Reliance, not HDFC Bank, what's going to take the Nifty higher?
Nifty doesn't have to go higher. It can go sideways. It can go lower also. We kind of assume that after 9 years, every year Nifty has to go up. But let's just wait and watch. We are entering into a very important earnings season. So far, it's been good. I must admit that it is better than my expectation. Auto numbers are better than my expectations. Some of the real estate sales which have come through are decent, and jewelry sales also have picked up. But typically the positive news flow comes in the beginning of the quarter, and then the bad news starts to follow afterwards. So let's see how actually things play out. But by and large, I'm not that positive. I still remain quite cautious on the market. And, we are at, I think, at an inflection point. And depending upon Trump policies, depending upon this earnings season, maybe even the budget, the longer term trend of this year may get determined.
Help us with your take on the counter, because it was just yesterday where the company has come out with the top variant prices of two of its newly launched electric vehicles, wherein for BEP Pack 3, the company has decided a price of close to 27 lakhs, and the base model has actually been priced at around 19 lakhs. And for XEV 9E, the top variant is priced close to 30.5 lakhs, when the base price was close to 22 lakhs. And Deepan, I remember while while the launch was happening last year, the debate was just around that given the tech that the company has been providing in two of its EVs, the pricing is really attractive. But at these price points, with its top variant now ranging between 27 to 30 lakhs, how do you see the demand shaping up, and how do you see M&M disrupting the EV market share?
First of all, I really like the analysis done. And except for Reliance, I'm in complete agreement that Aisha Motors, M&M, and Sun Pharma, three companies we and our clients are invested, I think have the best chance of outperforming the Nifty in 2025. And specifically M&M, I think they have really got the EV formula right. And now with good monsoon and pickup in tractor sales, and also UV sales, utility vehicle sales, I think it's company firing on all engines. So from that point of view, very positive on M&M. The P's also got re-rated. The stock is not as cheap as it was earlier, but amongst all the automobile companies, the growth dynamics are the best over here, and it is gradually increasing its market share across categories. So I think it's a company on the go. As I said, it's a company which we and our clients are invested in, so our view could be a bit biased. But yes, I think very positive on M&M, and we do hope that these kind of volumes are sustained for rest of 2025.
Dipan, I look at the other way around, which is that, okay, they've done well and they've done exceptionally well. Great launches, everything is fine. But the market share in the SUV market has reached at a level from which it should come down rather than go up, which is competition has intensified, their market share, which is more than 50%. While SUV is the buzzword, it may remain fashionable. But for M&M to keep on giving that surprise every quarter at that kind of an base with this kind of a market share could get limited.
Yeah, I think it's possible. In auto industry, there are cycles, and sometimes when the company has a lull of new models, it may tend to sales may tend to slow down, market share gains may be lost a little bit. But look, I think you see the strategy, all the new models which they launched are extremely successful. Of the three Indian passenger vehicle companies, I think they have the best plan in terms of EVs, the best in terms of new models as well. And mind you, I've taken a test drive of a couple of their models and they're exceptionally good. So from that point of view, when you look at a longer term view, that there's disruption in the auto industry, EVs are here to stay. And amongst the three companies which have the best strategy, I think that would be M&M. And look, they're delivering quarter after quarter in terms of financial numbers as well. And balance sheet quality has improved, return ratios have gone up. They are focused totally on the existing domestic market, and that's growing well for them. So I think it's a company firing on all cylinders. So from that point of view, I think it could be an outperformer.
Just scanning 250. Dipan, at some point in time, which is what I'm wondering when, there would be a realization which would be that quick commerce has become intensely competitive. Everybody now wants to have a pie of that quick commerce business. Now, from getting your grocery to getting an iPhone delivered in quick commerce to getting vegetables delivered late at night, everything is happening in 10 to 15 minutes. And when such a thing happens, it is good for consumer, never good for shareholders. Are we reaching that point for quick commerce companies, and especially Zomato, Swiggy, that it's time to take a differentiated view?
Any success is going to attract a lot of competition. There's no doubt about it. But the key is execution and early mover advantage. And I think that both Zomato, Swiggy have that particular advantage. And while they may suffer a few quarters because of intense competition, undercutting. But end of the day, I think the same thing played out in the food distribution business. But then these two companies survived, and now we have a duopoly kind of a situation over there. So let's just wait and watch and see. The market also is expanding. Right now, we are seeing quick commerce only in the metropolitans and the large cities. It could go down to tier 2, tier 3. Who knows how this actually will play out. So despite the announcement of so many new players, we are certainly not trimming our positions in Zomato and remaining invested. I think it's one of the very high growth sectors within the consumption theme. And at a time when a lot of stories and a lot of segments in the consumption theme are fast slowing down or have reached maturity, and you still want exposure to consumption theme, then these are definitely one of the choices you should select.
Anything else, Dipan, which could be called as a fallen angel in your book? While we may look at the market and still say it's expensive, but I was just looking at like a random list of stocks which have fallen, and stocks you would say that are good businesses you can recognize. Anox Group, Chola Group, Tube Investments. There are a lot of stocks which have fallen 15, 20, 25% in this market adjustment. Anything which pops up on your radar, Dipan, which you said, okay, I wanted to buy it, now I've got that 25% correction?
No, Nikunj. Again, we are going into stock territory. And again, I have to give a disclosure. We recently, did some sort of study on Symphony. And mind you, Symphony has been a great wealth creator over the last 2-3 decades or so. And it is the market leader in, as you know, in the air cooler business. It's totally focused over there. It has corrected, I think, more than 40% from its all-time high, maybe close to 50%. I need to check that figure. And it's available at reasonable valuations. We are definitely seeing that climate change is causing intense heat and intense winters as well. And intense summer, if it does happen in 2025, this company could be a major beneficiary. In 2024, it had the best ever year because of a very, very strong summer season. And that if it gets repeated in 2025, you may see the company doing even better. Some of the internal issues have been sorted out, and now I think sales are on an even keel. So when you look at companies which have corrected significantly from the top and available at reasonable valuation, and yet our bluest of blue chip companies, look at its ROC, ROE, balance sheet management, all have been phenomenal. And most importantly, the focus on just a single product where they are a market leader, and the kind of new products they have launched, all are very impressive. So, I mean, this is just a company stock to discuss. It's not a recommendation. It's just something we identified that which stocks have corrected significantly, the erstwhile blue chips, which are available at reasonable valuations.
All right, Dipan, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. But with this, let's move on, and let's also...
If you like this video, then like, share and subscribe to ET Now.